Okay, let's go on. To calculate interest and to take into account that sometimes a bond is issued at a discount or at a premium, and therefore the interest payment can differ from the interest expense. There are two different bond interest rate methods. There is the effective interest rate method and the straight line method. Both are there to take into account that interest expense can differ from interest payment. Yeah. So, but the thing is that only the effective interest rate is allowed. Under IFRS. Straight line is not allowed. Not allowed according to IFRS. And here you see how the effective interest rate method works. Yeah, yeah. We are dealing here with a bond, and the bond has a face value of 100,000. The thing is here that the stated rate is lower than the market rate. Yeah, see that? The stated rate is lower than the market rate, and therefore the bond has to be issued at a discount. Yeah, otherwise nobody would buy the bonds. But nobody would buy the bonds. Yeah, that's why the bond is issued at a discount, and this is the discount. This is the discount. Yeah, and in cell or in column E, you see the bond carrying amount, and the bond carrying amount is the face value minus the discount. Do you see that? Yes. So this is the face value minus the discount, and in our case it's 96,11449. So the payment of the bond, the interest payment in our case is 4,500. This is semi-annually. Yeah, semi-annually. It says the bond doesn't pay annually, doesn't pay yearly, but twice a year. Yeah, so semi-annually. That's why the payment is not 9,000 at once, but 4,500, and this is 2 times a year. So in July and January. So we have a payment of 4,500, and this is 4.5%, which is 9 divided by 2, 9%. 9 divided by 2. 9% divided by 2 equals 4.5. 4.5%. So we have 4.5% of face value. So this is 4,500. Yeah. Do you agree? Does it make sense? Yes. Okay. So, and now the thing is that our real interest expense is higher than the payment. Why is the expense higher than the payment? Because we have a market rate of 10%, and therefore we have issued the bond at a discount. We didn't get 100,000. The firm didn't get 100,000 at issuance, but rather it only got 96,149. So we have an additional interest expense, which is not paid, but which results from the fact that we had to issue the bond at a discount. Yeah, and therefore we amortize. Therefore we amortize the discount. So we take a fraction of the discount and put it into this period. Yeah. So you see here that the interest expense is not 4.5% like the payment, but it's 5%. Yeah. Which is 10%, 10% divided by 2, because this is the real interest, the expense that the company has to bear. Yeah, it's not 4.5, but it's 5. So this is the expense that the company has to bear, and it has to bear it. Why? Because it didn't get 100,000. It only got 96,149. So the interest expense is higher. The interest expense is higher than the interest payment. Yeah, the interest expense is 4,807, which is 5%. 5% of 96,149, and this is higher than 4,500. Yeah. So what is the discount amortization? It is this 4,807. Yeah, minus the interest payment, minus the payment. B, see that? B minus A. Yeah. So, and that's why the discount is lower now. Yeah, because it is amortized. It is amortized, and it is lower by this amount. Yeah, so it's 3,851 minus 3,544 is exactly, and if you calculate it, it's exactly 307. Yeah, 307. So here, 307. This is the amortization of the discount. Yeah. So the discount is now lower because part of it is amortized. Yeah. And we have a new carrying amount. Yeah, which is 100,000 minus D. Yeah. Yeah. So next round, next period, against our payment is always the same. It's just 4.5% of the face value. We have an interest expense, and the interest expense is 5% of the preceding bond carrying amount. Yeah, 5% of the preceding bond carrying amount. The preceding bond carrying amount now is 96,456. 96,456. This one. Yeah, that's the preceding bond carrying amount. and the interest expense for this period is 4,823. Yeah, discount amortization is just this B, this is B minus A, B minus A. Yeah, so the interest expense is really it's more than the interest payment, and the difference between the payment and the expense is discount amortization. Yeah, and the discount has to be updated again. Now it's even lower, yeah, because you have amortized part of the discount again. Yeah, and we have a new bond carrying amount. This is the effective interest method. Now you amortize the discount over the life of a bond with this effective interest method. Does that make sense, or are there any questions?
Clear.
Yeah, Raychan, clear? Okay. If there are any questions, just ask. Yeah, no worries. So discount amortization, it actually the effective interest method, and also the straight line method, but the straight line method is not allowed according to IFRS. The effective interest rate method amortizes the discount and makes it part of the interest expense. Yeah. So the interest expense does not only consist of the interest payment, but also of the discount amortization. Yeah, and it updates the carrying value. It updates the book value of the bond, and the bond the book value of the bond is always the face value minus the new discount. The discount, of course, updated as you just see. Okay. Now we have a couple of exercises, and you try to do them again, and then tell me your answer. This is the first one. What is an unsecured bond? And then you have to choose between those 5 things: mortgage bond, debenture bonds, registered bond, serial bonds, or term bond. What is correct? Liang says B. What about the others? Do you agree? Yeah, I also agree with Liang. Liang, very good. Unsecured bond is called a debenture bond. The estimated, next one, the estimated warranty obligation at the end of the financial year is best described as a contingent liability, constructive, unrecognized liability, or liability. A, exactly. A is correct. Very good. A is correct. Next one. What does the discount on a bond payable becomes? reduction in interest expense, liability in the year the bonds are sold, additional interest expense over the life of bonds, a reduction in interest rate the year the bond mature, or additional interest expense the year the bonds are sold. Take your time, think about it, and then we talk about it. What is the correct answer? Okay, B or C. Yeah, and C. Wait a minute, sorry. C is correct. Yeah, we just talked about this. The discount becomes additional interest expense. Yeah, interest expense is not just the payment, but the discount, and the discount is amortized over the life of the bonds. Yeah, the discount is amortized over the life of the bond. So C is correct. Very good, yeah. Does that make sense for the others? This is the next one. A bond that matures in installment is called term bond, secured serial bond, zero bond, or callable bond. Installment is yeah, okay. An installment is equal amounts. So equal amounts have to be paid, and the amounts consist of the interest and of a part of the principal which has to be paid back. So this is equal amounts. The correct answer here is, yeah, payments of part of a debt. Exactly. The correct answer here is serial bonds. Serial bonds. Yeah. The serial bond matures in installment, which is equal payments over time. Yeah. Equal payments in every year. This is the next one. The carrying value, book value of bonds payable equals. What is the correct answer? Exactly. Yeah. The carrying amount is bonds payable minus discount on bonds payable. Very good. Okay. Fine. Good job. Good job. Good job. Did you the next section is on shareholders' equity. Did you already get the slides? I don't think so. I have to send you the slides. 1 minute. These were the last slide you got, correct? So I get you. Now I think you should have gotten my slides. Did you get the slides?
Yes.
Okay, all right. Then we can move on with the next section about shareholders' equity. And can you explain in your own words what is shareholders' equity?
The net asset value of the shareholders.
The net asset value, though, yeah, the assets after deducting all liabilities, yeah. So the net asset value, so equity equals assets minus liabilities. Yeah, net asset value of shareholders. This is correct. Very good, Raychan. So if you are a shareholder, then you are the owner of a business. Yeah, you are the owner. The business belongs to you. You are the owner, and you also bear the risk. Yeah, but you also get the rewards. Yeah, when the business is doing fine, then the share price increases, and you reap the rewards. Yeah, that's the nature of being a shareholder. So equity represents share owners' residual claim on the assets after deducting all liabilities from the asset. This is what Raychan said, the net asset value. So shareholders' residual claim after deducting all liabilities. After deducting all liabilities. Now, this is the accounting equation. Yeah, as you know. Yeah. So when we talk about equity, it makes sense to talk about the corporation generally. Corporation is a separate legal entity. What does that mean, a separate legal entity? It means you can, for example, a corporation, let's say BMW is a corporation, and you can sue BMW. You can sue BMW, but you also can get sued by BMW. But if you have a problem with your car, you probably not sue. You cannot sue the CEO of BMW, but rather you sue the company, the corporation. So it's a separate legal entity. The share owners have limited liability for the firm's debt. That means actually that's one of the main advantages of a corporation, that the shareholder can only lose his investments, not more. Yeah, not his house or something like that, private property, but rather it's only the loss is also only limited to the investment. Yeah, we have a separation of ownership and management. What does that mean? That means that the owners of the business, they normally do not manage the business. Yeah, there are exceptions, of course. Yeah, for example, think about Amazon. Yeah, Amazon. They are the biggest share owner is Jeff Bezos, and he's also the manages the business. Yeah, but generally in a corporation, management and ownership is separated. Yeah, and the stock is traded between the shareholders. Yeah, so that means that after an IPO, the operations are not affected anymore. Yeah, operations are not affected when the stock is traded between shareholders. Yeah. What is an IPO? Do you know that? An IPO? Yeah, exactly. It issues the shares. That is an IPO. Here we have the we see how the separate bodies are dependent on each other. We have the share owners, and the share owners elect the board of directors. The board of directors actually is there to control the management. Yeah, and the management consists of the CEO, the CFO, and the COO. The chairperson is the boss of the board of directors. Yeah, so here we have the board of directors. The board of directors appoints the management and also controls the management. Controls the management. The chairman or chairwoman, the chairperson, is the boss of the board. And this in blue here, this is the management. This is the management. This is the management. Sometimes the chairman and the CEO is the same person. Yeah, sometimes those two are the same person. Yeah, at least in some countries. Yeah, in Germany it's not allowed, but in many other countries it's allowed that the chairperson and the CEO is the same person. When we're talking about shareholders' equity, there is paid-in capital and there's retained earnings. Yeah, paid-in capital is what the shareholders have paid in, and the retained earnings is the part that the corporation has reinvested in the business and not used for dividends. Yeah, but some companies have further subcategories, but that's too much detail. Yeah. Why do firms reinvest their earnings? What's the reason? Why do firms sometimes reinvest their earnings? They're running. Yeah. Go on. That's all. Okay. Yeah. So they want to retain their earnings and not pay them out because they think they have good projects. And it makes sense to retain their earnings. And those companies are typically companies which are growing very very fast. Yeah, think about internet companies, tech companies. They are retaining a big part of their earnings and not paying the earnings out as a dividend. Yeah. So here you see the a share. This is a share of Starbucks, obviously. Yeah, and equity is divided into shares. Yeah, many countries in the meantime have adopted electronic certificates. Yeah, but this is how a share looks like. If you are a share owner, you can look up the share at a company. Yeah, here you see a quote of the share. So here the Coca-Cola share trade at 41. This is US dollar, and here you see several ratios that are related to the share. Yeah, and here you have, this is the chart. Yeah, how the share has behaved over time. Yeah. Here you see returns for several asset classes. Yeah, we're having here. This is the returns over a very, very long time. So we started 1800. This is more than 200 years ago, and we go on until today. So we have data of more than 200 years. And here we have stocks, we have bonds, we have bills, we have gold. Yeah, the gold price. And we have CPI. CPI stands for Consumer Price Index. Can you explain what happened to these asset prices over time?
I think it's go up.
Yeah, Raychan, correct. They all go up, but which one goes up the most?
Stocks.
Yeah, by far. Yeah, think about your actually your grand what is it? Great-father has invested $1 in stocks, and now it's worth 12.7 million. Yeah, do you see that?
Yes.
So this is huge. Yeah, $1 in 1800. This is 1800. It's a long time ago, of course. But now you have 12.7 million. This is far better than bonds. Yeah, bonds has 18,000. 18,000 is not bad, but 12.7 million is much better. So stocks have performed over long periods of time. Stocks have performed the best by far, better than bonds and bills. What is the difference? Do you know what is the difference between bonds and bills? What's the difference between bonds and bills? Yeah, it pays interest, but bonds is long term. Bonds is long term, and bills is short term. Yeah, bonds is long term, and bills is short term. Both are fixed income government securities. Yeah, both are fixed income securities issued by the government. Yeah, you can bills are short term, and so they mature earlier. You can buy and sell both securities, both bonds and bills every day. Yeah, it doesn't mean when you say bonds are long term, that doesn't mean that you cannot sell bonds every day. You can sell them every day, but nevertheless, they mature only after a couple of years. So that's why bonds are long term and bills are short term. If you look at the fluctuations of bonds and stocks and bills, what do you see there? Which of those assets is the most volatile? Which fluctuates the most? Yeah. Stocks fluctuate the most. They are the most volatile. So they are quite volatile. Bonds fluctuate less, and bills fluctuate the least. Yeah, bills fluctuate the least because they are short term, and short term investments, they fluctuate the least. They fluctuate very little. Yeah. So here you really see that stocks are a very good long-term investment, but the fluctuations in the short run are quite high. Yeah, they are very good long-term investment, but the fluctuations in the short term are quite high. When we're talking about classes of shares, we have ordinary shares and we have preferred shares. Sometimes these ordinary shares are also called common shares or common stock. Most firms actually only have ordinary shares. Yeah, in Germany, about 80% of the firms only have ordinary shares. What is the difference to preferred shares? Preferred shares have lower risk for the buyer of the stock. Yeah, why? Because preferred shares are served first. Yeah, they receive dividends before the ordinary shareholders, and sometimes they are even paid back from the company. Yeah, but the drawback of preferred shares is that they have no voting power. Yeah, they have no voting power. But in Germany, we have a lot of family businesses, and these are family businesses that are quoted on a stock exchange, and those family business, they they issue preferred shares because they want more equity, but they don't want the outside shareholders to have a saying. Yeah, they don't want the outside shareholders to have a saying in the company. They do not want them to have votes. So the ordinary shares is the basic form of share capital, and the ordinary share owners, they often bear more risk than the owners of preferred shares. Yeah, and the preferred shares, they give owners certain advantages over ordinary shares. I just mentioned that in the case of bankruptcy, they get served first. They get served before the ordinary share owners, and they also have dividends, or they have higher dividends. Yeah, sometimes they even have fixed dividends. Yeah, for example, 6% of par value or something like that. So they have fixed dividends, what a common stock never has. Yeah, this is preferred shares, or preference shares are also called mezzanine capital, because it's in between equity and debt. Mezzanine. Mezzanine capital. And these are it's called mezzanine capital because they are hybrid instruments between ordinary shares and long-term debt. Yeah, and according to the substance of the contract, then they are either shareholders' equity, or they are a financial liability. So they are preferred shares are something in between equity and debt, essentially. Here you have an overview between ordinary shares, preferred shares, and long-term debt. In this table, you see whether they have an obligation to repay the principals. With no share class or no company that issues any type of share has an obligation to repay the principal. Yeah, there is no principal for stocks. For debt, of course, it's different. Yeah, for debt, it's different. Debt has to be paid back, the principal. Yeah, the face value has to be paid back. For stocks, there is no face value, and therefore they do not have the companies do not have to pay back. A dividend and interest. Dividends are not tax deductible. Yeah. So shares, preferred shares, and ordinary shares pay dividends. They are not tax deductible. Interest rates are deductible. Interest rates are deductible. So what does that mean? They are not tax deductible. That means a company first has to pay taxes, corporate taxes, and then out of the money that has already been taxed, those companies pay the dividend. For interest, it's the other way around. Yeah, you pay the interest expense before before the taxes. Yeah, actually, the interest reduced the amount of taxes you have to pay. Deduct them. You can deduct them. So that is an advantage of debt over equity. That interest payments are tax deductible. Yeah. So here, this is an advantage. Yeah. If something is tax deductible, it means it reduces the taxes. And is there obligation to pay dividends or interest? For shares, generally, no. There is no obligation, only after a declaration, but generally no. When we're talking about debt, of course, there is an obligation to pay interest. Yeah, shares do not have to pay dividends, but debt and companies that have issued debt have to pay interest. Yeah. So to sum it up, for shares, there is no principal, and shares do not have to be paid back. Debt, of course, companies have to pay back debt. Yeah, they have to pay the principal to the owner of the bond. Yeah. Dividends are not tax deductible. Interest is tax deductible, which is an advantage for that, for interest. Dividends, there is no obligation to pay them. Yeah, but interest in the case of debt has to be paid. Does that make sense? Or are there any questions? It's clear, yeah?
Yes.
It's clear. Yes? Okay. Very good. Very good. Then I would say we have a break here, and see you. Yeah.